Hi, this is Jeffrey Scott. Welcome for a special episode of the Ultimate Landscape CEO. This is a podcast recording from a live LinkedIn live stream where Kelly Dowell interviews me on the aspects of selling your business or retiring in place. Honestly, that's how we set out. That's how we started out with this concept. We talk more about the selling and buying aspects and a little bit less about retiring in place. We still cover both. We definitely dive into the mindset of the buyer and the seller. I think you'll find that very intriguing. The myths that buyers and sellers have in the acquisition process. I, of course, touch on how to maximize the value of your business, whether you're selling it or retiring in place and want that value for yourself and your team. We talk about how to increase the saleability and the transferability of your business. I also touch on family succession, of which I have a lot of experience, and of course, post sale considerations. We take questions from the audience. We had many people online for this event. So it's a jam packed event. Now, if these topics are important to you, you can also join us for our fifth annual financial masterclass, which we're holding at the very beginning of January. But you have to sign up now and get your numbers in now because we create the benchmarking database, if you will, based on numbers that you would have right now, and it takes us some time to process. So if you go to my website, go under events, you can sign up now for the financial masterclass. We'll touch on issues of cash flow, building profitability, making better, smarter decisions by understanding your numbers. We have a few guest speakers. We'll touch on the 2025 economy. We'll touch on someone who's been through 10 acquisitions, and really we'll talk about how to build your business for value, not necessarily selling. That's not the focus here. Really, we want to train owners and leaders within a business on how to build a healthier business, if you will. And there's really a huge overlap between a healthy, strong business and a business for sale. Much overlap, more overlap than there is not overlap. And so a lot of value in our financial master class. Sign up now. And here we go for this podcast.
Let's just get going. So let's start with understanding the basics of selling your business. So again, we're talking about a good, proper valuation. So what are the options for selling? Who are these buyers? What do they want? What are they looking for when they decide they want to buy a landscaping company or lawn care company?
So there are really 7 options, 6.5. The
Okay.
half is liquidating, right? You might decide your business is too small, not worth the headaches, and you liquidate it at the end. So that's the half option. And then you can sell to someone via a broker. You just put it up on a broker's list and you can sell it. So that's one way to find your buyer, which is often a private buyer. The other way is a strategic buyer. There's a lot of landscape companies regionally that are buying up other landscape companies. We'll call that a strategic buyer. And that's a very plausible option these days. Then, of course, there's private equity. We all know about that. You can read about that. Everyone gets an email once a week from private equity. The other option is ESOP, Employee Stock Ownership Program. And that's usually for companies that are like 10 million and larger. There are some well-known ones out there like Davy Tree, and there's Ryan Lawn and Tree is an ESOP where we held our summer growth summit last year. That comes with some risks, and you don't get payouts as quickly as you might think. It also has some advantages in terms of buying other companies. You might sell it to your own GM and your own team, and I'm working with one client right now on that option. And then, of course, you might sell it to family, which is almost a whole separate webinar, but we'll cover that a little bit here. And so those are really the main options. And when you ask why do they want to buy, I mean, hello, why does anybody want to buy? They're trying to either secure a job if they're family and a legacy, or they're trying to expand their business if they're PE and they're trying to roll up. Uh, or if they're a private person, they may be parachuting out of corporate America and, and tired of that, and they want to control their own destiny. So those are the common reasons, the common buyers and the common reasons.
Okay. Um, so what would be some common myths about selling one's business? I know this is such a hot, trendy topic right now, but I feel like there's a lot of misinformation out there. What are some things that sellers might think are true, but are not?
So, 6 myths. Number one, that the sale can happen fast and that it can happen easy. Negotiation takes time, and it's brutal when someone is like peeking and poking around your personal stuff and
Mm.
keep asking for more information and more, and we need this and we need that, and they want to interview this person and they want to negotiate that. So it's not fast and it's not easy. Number two, the big myth is you can work with the buyer after the sale. You're selling the business, and
Yeah.
you may think there's something for you on the other side. And yes, you may be required to, depending on how you negotiate, to do something after the sale, but it's not happily ever after. Number three, this is like half a myth that your team will love the buyer. Well, maybe they will, maybe they won't. That's why you want to be careful who you're selling to. Myth number four, the buyer needs to know the industry. It certainly helps in some cases, but in other cases, it just doesn't matter if you're selling to a good person with competent skills that can take over from you. Myth number five, the buyer needs deep pockets. There's ways to borrow money. There's other other setups out there to get money, and so you just need to know how they're going to finance it, right? And myth number six, ready, Kelly, drum roll. Myth number six is that you're going to get rich. And what I mean is, of course, it depends on what you're selling, but you've got to pay off debt, you've got to pay taxes. And I'm going to say that often it's not as much money as you may initially have dreamed of or thought of.
But that's why we're on this webinar, right? We're going to figure out how to get as much money as we can.
Hey, we got to bring reality. We got to throw some cold water on this first.
Yeah.
Those are the
Okay.
myths.
All right. So if I don't want to sell, we don't want to sell our business. What are some alternatives to selling? How do business owners make it work to take more time off, but still make money from this baby that they've been growing their whole life?
Yeah. I'll give you a couple things, and I'm sure we'll touch on them more later. But number one, you can retire in place, right? You can set up the business to allow you to work less and still generate your salary and even your dividends, right?
Okay.
I did a podcast with Craig Atkinson. If you don't listen to my podcast, it's the Ultimate Landscape CEO. We have followers from all over the world. It's pretty amazing. And so he was on a podcast just recently. And when he hired me to coach him, he was able to take 3 weeks off at a time. Pretty good. And now he can take 4 weeks off at a time twice a year. So he literally takes a whole month off. Um, and so if you can set your business up to do that like he is doing, then that's a great alternative. You could also develop, and actually, this is connected. You could develop a leadership team to run your business, and you can just check in time to time. That's really what Craig has done. Now, there's a pro and con to not selling. The pro is you get cash flow and you can diversify, right? Why sell the business when it can still pay you money and you can use it to start other hobbies, go racing like I do, or invest in real estate like I do, and many, many people do. Now, the con is, well, you're still holding the risk, right? You haven't fully dealt with that risk. You're still in the business, but I'm going to call it a con. It's depends on your attitude towards the whole thing. Um, but those are some alternatives right there, Kelly.
Okay. Awesome. I did throw the Craig Atkinson podcast into the chat box. So if you guys want to check it out, check the chat, and also feel free to enter your questions in there too as I'm monitoring it.
Yeah.
Let's talk about preparing your business for sale and the health of your business. So I guess in order to prepare your business, you need to know what buyers are looking for specifically. Specifically, what do they want?
Well, private equity wants to know your EBITDA, right? Earnings before interest, taxes, depreciation, amortization. Google it if you want the definition. Let's just call it cash flow. It's not really, it's not the exact same, but it's a measure of your cash flow. And so they want a business, the buyer wants a business that's not owner dependent, right? We do
Right.
not want to buy a business that's owner dependent. Therefore, they're buying your employees and your client base, right? There's owner, employees, and clients. So there, you want to be able to present that in its best light. Now, of course, there's more than that, right? It's much more complex. They want to buy the whole system. They want to know you have a good system and a reputation, yada, yada, yada. But to simplify it. And so a smart individual buyer might care a little bit more about what they're buying. But everybody wants to know that you've got a quality team, a leadership team. A smart buyer will want to know that it's disciplined. You have a disciplined team in place, and of course, a strong culture. And not just of the leadership team, but the next level down. A smart buyer will want to know that next level down. I had a client years ago, and he was just a peer group client. I didn't coach him, but he had just bought the business from two owners, and they assured him that there was quality of employees. He just didn't dig enough. And this is maybe a cautionary tale because what he found was there was two owners. That should be maybe a red flag. The two owners were doing everything. The employees really were not doing much in middle management at all, and the systems weren't really there because the owners had it all in their head.
Yeah.
And so you you cannot get bamboozled like that. I don't know how he did because he was a very smart person. So what another client of mine told me is you want to work with somebody of integrity because uh, they can they can hide things from you. That's when you're buying a business. So you really want that. You want to be honest as much as you can with the buyer, and um, you want to be able to trust them so you can share with them so you can get a good relationship. So the employees is number one. A smart buyer wants to know you got the work, recurring contracts, low concentration of any one client, incoming pipeline of work, right? So they're buying the team, they're buying the work. But an individual, if they're going to keep your brand, they're buying your reputation. I mean, even a PE is buying your reputation. Um, but that's even more important if it's an individual buyer. The smart buyer wants to work with somebody of integrity. I said that. They want to work where there's client relations tied to the employees, and there's a history of retention. And they want to buy growth potential. We see that the business is here, but it's got a good trend of growth. And when I buy the business, I don't have to jumpstart that growth. It's already happening. So there's just a summary of what a smart buyer is looking for. We'll cover some more
So
details, but
So a
that's a
lot
good
of
overview.
what you said though, Jeffrey, is that the buyer's not looking at the owner. Like, and I think that might be a little bit of a hard pill to swallow because we've done so much as the owner to really build this thing up. It's been like, our child for so long, but it comes down to way more than just you.
You had the vision, you had the dream, you have to get out of the way. And
Okay,
so
cool.
you're we're going to talk about this throughout our short time together and even at the end because what you just said really hits a nail on the head.
Yeah. Yeah. So, all right, if we're talking about the team, we're talking about the business, the reputation. One of the things you said was the growth potential and then like the work. You have the reoccurring contracts. So how should companies build that sustainable revenue model that really appeals to potential buyers?
So it's recurring revenue is what investors want. They're investing in something that won't just go away when the economy blips.
Yeah.
And so I think they're warming up to install, but just a little bit. In other words, they've gone from cold to not super cold to just warm cold.
Room
So they're warming
temperature.
up to it a little bit, but recurring revenue is important summer and winter. And so that means contracted revenue, revenue under contracts. T&M per push, that's not contracted revenue.
Yeah.
So building the contracted revenue model is a good base. Also, enhancement sales, that's selling extras to existing clients, showing a history of that, showing a high percentage of that is very important. And I would also say if you don't do plowing, for example, I think not working could freak out a buyer, even if it's built into your model. Like you know how it works. Maybe you're used to taking winters off, uh, and you know that the P&L still works, but it's not going to make a buyer happy. So if you can close that no work window, shrink it down. One common way to do that, for example, is Christmas
Christmas
lighting,
lights. Yeah.
right? Christmas decor that can shrink that window of no work down. And it really can't be things like we're going to rebuild a house because a buyer, I mean, you can do that, but you can't sell that. So as long as you recognize that. So getting that foundation built out is a very good start and ultimately what is going to attract the buyer.
So you talked about per push. Would you recommend, this is kind of getting in the nitty gritty here, but for those snow companies, would you recommend they split their client load between the per push in the winter and contract base and mix the two just to
So
even
here's
it
the
out?
thing. It's a good question. Here's the thing. The buyer wants to buy contracted work. So a uninformed buyer or even an informed buyer would like to see a heavy amount of seasonal, which is, contracted work. But you might recognize in your market that you need a mixed portfolio to protect cash flow year after
Right.
year. So, you got to do what's right for the business, but if you don't show enough contracted work, it's going to reduce the value.
Yeah. Okay. Heard. So let's say in this scenario, my company is 90% design build. What do I need to do now in the next 3 years, in the next 5 years to get this thing to be more appealing to buyers based on all of the things you just said about recurring revenue and contract work?
I worked for years with Drost. We held one of our summer growth summits up at Drost. They have since sold on the PE market. And from the minute they hired me, drumbeat, 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 you've got to grow maintenance, Mr. Drost. I called him Bob. But and every time I talked to him, he must have been sick and tired of me saying this. But when I met them, they were a design build monster. They just such a reputation. And they did. They took it to heart. They built maintenance and I worked for them before they sold at least 5 years, maybe seven. And they built out their maintenance. They bought a tree company and built that out. They built out the irrigation service. They built out so many services that they hired a director of services to oversee all their services, and it paid off. And so the lesson here is 3 years is too short. You're selling in 3 years. Good luck. By good
Yeah.
luck, I mean you can't. What do they turn a sow's ear into a silk purse? To do that, you need, let's call it 5 years or more. And so
If you're
you
at
got to
like
look at
90% design build now.
you got to look at least 5 years out to start making those changes, and you've got to do some acquisitions and change the culture and have a real strong leader in service. You can't have a weak leader. I work with a couple companies. One I think is listening right now. as maintenance leaders, maintenance has always been a second thought, and it's growing now. But now this owner needs a real strong leader in maintenance. So that's one thing. The only other thing I'll say is, of course, install work you're selling to existing clients looks more is looked upon more favorable than to outside brand new clients. So you
Mm,
could even take your design build or your install and separate it into two
okay.
categories because one of them looks more like recurring maintenance, even though it's install.
Okay. So, what strategies could companies use to strengthen their brand reputation, their market presence? That maybe are some immediate things, maybe are some that 3 5 year along the line strategies.
Yeah. Well, let's first ask, does the buyer want to keep your brand?
Okay.
Some do, some don't. You might want to know ahead of time which is most important or which you're likely to sell to if you're going to sell. And then you want to know, are you going to be their platform company, or are
Oh,
they just going to tuck you in, your client base in, and they're just going to fold your brand in? And so that will impact how important your question is, Kelly.
yeah.
The way to strengthen your brand and your market presence is the same way you would use to just grow your business. So,
Okay.
in theory, you're already doing this.
Yep.
The clean website, the up to date website, the clean truck branding, hopefully unique truck branding, the consistent use of social media that's not just driven by the owner, but there's a team. There can always be an owner face in social media, depending, right? LinkedIn has more of a person. Other, Facebook could be more of a company. I mean, you know more than me there, but you know what I'm saying. So, not overly dependent on the owner. Paid marketing where relevant, have good marketing dashboards at hand, a good CRM. Ironically, there's a lot of softwares out there for our industry, Kelly, that have poor CRMs. So, um, if I'm buying your business, I really want to see all that in place.
Yeah. So I want to touch on this because you're kind of getting into my world here. But a lot of clients will come to me, and I work with them on making sure that their personal brand stands out, especially on LinkedIn. So especially in that commercial market too, where they're looking for that personal relationship and getting their foot in the door in that way. So it's very interesting you say that because it's not either or, it's both and. We need to have that good, strong leadership person who's making those personal connections, but also your brand has to be strong too. So I think that's very interesting that you said that.
And that goes to, there's a lot of overlap between growing a healthy business and growing a saleable business.
Yeah.
And some, it's not a complete overlap, and there are some differences. So that personal branding is excellent for growing the company. Um, but if we know we're going to sell in 3 years, we're probably going to make changes in those 3 years.
Yeah. All right. So here's something a lot of people want to know. It's the financial metrics and the KPIs. What do we need to focus on to improve that overall valuation that we're going to get for the landscaping business?
So there's probably 30 KPIs, and that
30.
would
All right,
take
let's dial that down.
yeah. Well, that would take a separate um, live stream or webinar. But let's understand the basics, right? Everybody talks about EBITDA, so that's metric number one. Uh, Net profit, and I want to say you should have at least 10% net profit after depreciation. Otherwise, what are you doing? Like, why sell the business unless it's a $1 billion business? You fix the business from a profitability standpoint. I talk to clients, a couple that have gotten their just beat up from the backlash of COVID and the drop in economy in the past year and a half. Oh, I think I want to sell. Really? You're at 3% net and you want to sell. The whole point of investing is buy low, sell high, right? And it's often, same with stocks, it's often counter When your stock is going down, you're like, I'm going to sell. Well, no, that might not be the time to sell, right? So don't kid yourself. Get a high net profit if you want a high valuation. It's all doable. That's why I have a coaching service and people work with me. I become their, or my team, really. We now have a team, and our team becomes their competitive advantage. And I'm proud to say I have uh, employees and associates working on my team where my clients love that person. It's
Yep.
great. They love that person. So, I walk the talk, and in 95% of what I'm telling you to do, I'm doing what's applicable in my industry. So, all right, back to the metrics here. So, EBITDA, net profit, and of course, gross profit. I think a smart buyer will understand that. And really, cash flow net to owner, right, which is similar to EBITDA. But if you're a private buyer, you want to know what kind of cash am I going to get from this business?
Yep.
Capital expenditures. If you're a smart buyer, you want to see a history of that, some trends. Have you been milking the business to get the numbers high? And there's going to be a headache once I buy the business? Or have you done a steady job of growing and investing in the business? I'd also want to see debt, right? Same thing there.
How far back do these numbers go, Jeffrey?
Well, let me get to that in a second. So let
Okay.
me just sort of finish the little list here. We talked about recurring services, right? So let me break that down. I would break down recurring revenue from new and renewal. Whenever I analyze a business and they give me their revenue, for example, I'm like, no, 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 no. Separate your renewal numbers from what you're selling new. There's a whole story once you separate the two. So a smart buyer is going to want to look at those separately. Even if you have a positive trend, I want to look at both halves of that number separately in the positive and see if both halves show a positive trend. And of course, enhancements, right, which we talked about for recurring, and then conversion ratios, outside leads, and then internal from design, build, to maintenance. So those are different ways to break down revenue. Then there's some other miscellaneous ones like per employee metrics, revenue per employee, and some metrics like that. Uh, Also, show me you've been closing the books on time so that I know your numbers are clean month to month. And it's more of a accounting idiosyncrasy, but that's how you get clean numbers. And even a mod factor, which is not talked about a lot, but if you're smart, you're going to want to buy a company with a low mod factor, workers' comp, and a good safety history. Now, it trails a year, so it's not. So you have to understand that. But I think that, there's some miscellaneous metrics that a smart buyer will want to know as well. So, like I said, there's easily 30, but those are really some of the basics that I would think about from a financial metric. In terms of how far in advance, 3 to 5 years. 5 is ideal. But if you have 3 years of clean, good numbers, that's going to give me confidence.
Great. Cool. Any tips or pointers you have for people who are like, holy shit, that's a lot of like data I have to find through all different sorts of platforms and stuff for the 3 5 years? I mean, any pointers?
So I just gave you a way skinny down version. If that gets you overwhelmed, uh, you're not ready.
Okay.
But no, okay, but still, your question is a good one. You need to have a great office manager, controller, or if you're larger, even a CFO, and a good accounting system in place, good operational software. Smaller companies use QuickBooks, larger companies are off of QuickBooks because it just doesn't help as you really expand. So the right infrastructure will help you with that question you just asked.
I love that. A strong leadership team is going to play a huge role, as we kind of talked about and alluded to earlier. It's not just coming down to the owner anymore. So, what are some maybe intangible things that you can do to prove the strength of your leadership team and your middle management team for that matter?
Yeah. So a team that's willing to stay in transition, I just want to say, is paramount. Since it's owner independent, we're pulling the owner out, what's left after the head? The shoulders and the arms, right? So, and the whole body.
It's a nice visual.
Yeah. And so we need a team that's willing to stick around. Um, and so, how do you prove that you have a strong team? Well, Craig Atkinson, Craig, I hope your ears are ringing. We're talking about you again. So, you need to prove that you have well, you need a strong team, and then you need to prove that it's strong. So, if you can show that, hey, I go on vacation quite a bit, I take a week off a month, 1 week a month, or a full month off twice a year. All right, and look, our numbers have been great through that. That's proof, right? The proof is in the pudding, it's in the fruit. But also, also having a clear org chart. In EOS, they might call it an accountability chart. They want to say it's different, but it's really the same thing. So, an accountability chart, here's what people do, here's who they report to, here's what they're accountable for, here's the KPIs that each of them are accountable for. I would have that figured out as well. Uh, and so that can help quite a bit. That your team is financially aware and you can show that your team has financial responsibilities is a plus. That's why we have people bring their teams onto our financial masterclass, which we're doing in basically the first full week of January. I think it might show up as the second week, but um, basically within the first full week of January. You want to throw that code or that
Yeah.
link
Yeah, I got
up
you.
there. So that can help quite a bit. A strong leadership team, I would say, has a certain amount of cross training. What happens if we lose one of these four people? Well, these three people know how to do that person's job, plus the person underneath. And so when you want to prove a strong team, you want to prove that they're not fragile, meaning they can only do one thing and that they can really work as a team and they've got some, resilience and flexibility.
Okay, awesome. We've got a couple questions here for you, Jeffrey. Chris at Green Unlimited Lawn Care says, do you recommend smaller companies teaming up to increase their overall size to drive a higher multiple for exiting? And would showing a presence in multiple cities through this also show a stronger position?
So let's break that up.
Okay.
Can you partner up for a stronger valuation? Well, that sounds like they're asking about merger, and I'm going to answer it a little bit different because mergers of equals is, um, it's messy. That's a whole separate webinar. But if you're thinking of selling, it makes sense to buy first, right? Buy low, sell high. So if you buy a smaller company at a lower valuation and you bundle it together into your company, you then have a larger company that, in theory, could have a higher valuation. So that's how I'd answer that first question. And that's an absolute yes. And then if you're asking, does being in multiple cities add to the value? That depends. It really depends who you're selling to and if that's what they want. If you're selling to a private buyer, I don't know if they may want that, they may not. If you're selling to a strategic buyer in the same state, they might be okay with that actually. And if you're selling to private equity, it just depends on how well that company is performing. So in itself, it's sort of neutral, and it really depends how well what you've put together is working.
Okay. There you go, Chris. Hope that answers your question. Kind of this is related to that question that he asked is how can a company identify new market opportunities, maybe even service areas that align with their business's growth goals?
So you're asking me about new markets, right?
Mhm.
I just want to talk a little bit about reports. We were talking about KPIs, and then can I do that and then
Yeah, absolutely.
jump to new markets? So what kind of report should I have? The more, the better, right? We talked about all those KPIs, and the the person who might be overwhelmed at those KPIs will really get overwhelmed at the kind of reports. But really, you've got marketing, sales, operations, finances, employees, and a buyer's going to want to see reports on covering all those areas. They're also going to want to see lists of contracts. Show me all the non-competes
Mm.
and other kinds of contracts you have in place. So you're going to want lists of those. They're going to want to see your scoreboard. How have you been keeping track of this and managing it, if you have? And they'll also want to see some trend analyses to prove growth. I am coaching a company right now in the Colorado area, and he's in one of my peer groups. And he was thinking about selling, but he's not going to. But he's put together these trend analyses where he can, you know, be his own investor, so to speak, and watch his company with the eye of an investor. And we look at different line items together and to just make sure we're trending in the right direction. And I think any buyer would love to see that type of reporting as well. So you really need a good software to pull this together. The better the software and having a controller type person in your
A
business,
leadership, someone to
right,
organize it.
the easier it is to pull this together. So I wanted to say that about reports.
Okay.
So in terms of identifying new market opportunities, um, I just had a conversation with somebody they're about my age, and they just went through a little crisis, and they're thinking of selling the business. Again, not the best time to sell when you're emotionally distraught. Uh, and he asked, should I fix up uh, this part of my business here before I sell it? Or should I fix up this part of the business? And I said, well, if you were to sell your business today, would doing that item add or subtract to the value of your business? And it was sort of a light bulb moment for that person. Oh, I can use that to make decisions if you're my age or older and you got limited time and resources. What are you going to invest in? So, new market opportunities and service areas. Will it add or subtract to the value of the business if an outside person would buy it? And then the other question I would ask is, if I'm going to keep my business and not sell it, does that new opportunity or service need me personally? And will it produce more cash flow? Because if it's just ego, but no new cash flow, or it looks great, but it's really going to need me, neither one of those are great, especially when you're older. If it needs you, if you're younger and it needs you only for a couple of years to get it up and going, fine. So I would have a couple filters like that first. And then in terms of analyzing the new service, we have to figure out, is it demand driven or supply driven? Demand driven, Kelly, is all my clients are asking for it. Supply driven is, well, I see a lot of people doing it. It looks fun. It looks sexy. I should do that too, even though no clients are asking for it. And so you really have to separate like that. And lastly, my pet peeve or pet item is, can we grow it to $1 million? Can it become a self-standing business? And if you have a large business, you're probably thinking, can we grow it to 5 million or 10? But if you're smaller, can we get it to $1 million? Or is it just an add-on service that some existing manager has to manage? So I think those 4 questions will really help you put a screen and a filter to assessing new opportunities.
I love that. I get clients that we talk about this a lot. Like, should we add outdoor lighting? Should we add, audio? Should we add irrigation? Should we add tree care? All these different things, right? And so I love those 4 questions that you alluded to figure out if it's worthwhile. We do have a question here from Blair at Rain One. Could you briefly touch on what you're looking for between new revenue and renewal revenue, Jeffrey?
Blair, hey man, it's been a minute. So ask that question again. What am I looking for in terms of new revenue and renewal? Well,
That's it.
I don't know if this is the answer you want, but you want both. So You want your renewals to be high for the industry, high industry percentage, and you want a steady flow of new. So, uh, for example, if you're, I'm going to give you the cynical examples. Revenue's going up, revenue's going up. Oh, let me dig into it. Well, no, we've been raising prices, and that's why revenue's going up. Well, how would I really see that? You might see it through the renewal numbers being higher and the new numbers being lower. That's why I want to separate the two. That's just a cynical example of, so I want to see that, oh, you've got a steady supply of new clients coming 10% a year, 15, 20, whatever it is. Some are even higher, 30%, but let's call it 15%, nice and conservative. And then I also want the renewals to be there at a high percentage and with inflation bumps every year or two and enhancement sales being driven off of both clients. So it's really the matter of showing that they're both functioning separately.
Yeah. Okay. I have a question for you, Jeffrey. No one's asked this, and I'm shocked, or maybe I'm just illiterate. But how much is my business worth? Where do I go to find this out?
Kelly, your business is priceless.
Thanks,
You
Jeffrey.
come to the right source. So I'm working with another coaching client right now, and he's going to sell the business. And I talked to him yesterday, literally, and we came up with 5 ways he could sell the business. And really, he likes one, he likes 2.5 of those options. And so we're really going to focus in on those 2.5. And I said, let's just get our own valuation done before we go out to the marketplace. Let's get a baseline. And so he hired a local valuator, not in green industry specific, not working for him obviously. And so he's going to get a baseline, and then when he starts off in this journey, he's got his expectations sort of dialed in. And so his negotiation styles would be different depending on who's going to talk to, and I can't divulge any more than that. But him figuring out if he likes the number that comes back from that his own valuation really will help remove some of that anxiety or free floating anxiety and give you some facts to start the process.
Yeah. So, I mean, maybe using that client of yours as an example, or just thinking out loud here, how does he or how do the sellers kind of vet their buyers? Is there anything that they should be looking for in particular? Any red flags to avoid? Have you heard any horror stories or maybe good stories? Share some experience here with vetting the buyers and finding the right fit for you.
So even though this is a transaction, I think integrity is the most important thing on both sides, by the way. I work with buyers and sellers. And so do you trust the other person? Are they going to be honest? Are they going to share with you all the information you need? Especially if you have any type of working relationship after the transaction happens. But even if you don't, you may want your employees taken care of. So really trusting that person first and foremost, I think is so critical. And then, do they really want what you're selling? And I know this sounds funny. Do they want what you're selling? So you're selling your business, but you're really going to make an asset sale most likely. So you're selling assets. They're not buying your heart and soul, Kelly. They're not buying your love. They're buying the fruit of all that, which shows up in terms of assets and goodwill. But do they want all of your assets, or do they just want a piece of what you're selling? And so I think you can't make assumptions on that they're buying what you're selling. Number 3, do they have some kind of connection to the industry? It's a plus, not a must. But some buyers might insist on it. My guys want to know that you care about landscaping, and other sellers may not insist on it. My guys just want to know that you care and that you're going to be a fair owner. So that's really more of it depends. And then lastly, I want to know how they're going to finance it, right? Are they financing through family and friends, bank or SBA loans, private equity, seller financing? Banks will dictate valuation to some extent, and so could obviously private equity and others. So how they finance it could impact valuation. Now, I think it's a red flag when they want you to carry a note, part of that. But listen, if I was advising them right now, I'd say get the seller to carry as much of the note as possible.
Right.
And so, within reason. So it kind of depends on what side of the coin we are here. Um, there are some advantages to carrying some of the note. You can push off taxes. You can maybe charge interest rate, depending on how they're financing, a higher interest rate. So there could be some advantages for you in those areas. But it also means you're stuck in the game and you may not want that.
So, as we're talking about this relationship and negotiation, maybe how would you recommend negotiating the best terms for sale?
It's a lot like negotiating a house. Get competing offers. You
Mm.
only got one offer? That's not good. You've got 3 or 4 bidders? That's excellent, right? We call that bidding up the price. So you want competing offers. Don't just consider the first offer. Uh, it's flip a coin if it's great or not great, but I'm going to say chances are it's not as good as what you can ultimately get. Number 2, you want to know how bad they want it. Let's go back to real estate. How bad does the buyer want that house? Have they fallen in love with it? Is there a reason they've fallen in love with it? So figuring that out is important. I would say you want to use a strong broker or rep, just like you really want to use a realtor. Now, realtors don't always get you the best price. They want to get a deal. So just keep that in mind. And if you're going to try to be your own rep, it's like being your own doctor. Well, you better be good. You better be educated. Uh, so that one, it's an emotional sale. So having someone who's unemotional helps. Like I said, get an independent evaluation. Watch for the earnout. I think the earnout is common. We're going to pay you over time, but you better be okay if you don't get the earnout.
Mm.
I have a client right now. This is another client. We're helping her sell her business, and she made the deal, and there's an earnout, and she's like, "Oh, that'll be easy." Oh yeah, it was easy when you own the business. It's not easy when you don't own the business and you don't know what's going to happen next year with the economy. You can't put that on autopilot. And in fact, you have to assume you're not going to get it. And then by doing that, do your best to try to get it.
Right.
Also, the SBA has their own rules. So if you're going through some kind of formal financing like that, know what their rules are and how it will impact your negotiation, because it will.
Yeah. What would you say the pros and cons are for selling the business outright or considering seller financing?
Well, if you do seller financing, you in theory can get more buyers on paper, right? A larger pool. You can defer some taxes. Uh, Depending on the financing, you might be able to charge a above average interest rate. And now with interest rates going down, all of a sudden it becomes interesting now to get a higher interest rate versus just putting your money in the bank. That fun little CD period is going bye. And then seller financing may earn you might be a way to like look at it as an investment to spread out getting your money. And the cons should be obvious, right? A lot more risk, more headaches, more angst, uh, a chance you won't get the money. You're in. It's like that mafia. I try to leave and they suck me in, and you're just going to be sucked in. So those are some basic pros and cons.
Yeah. Is it better to sell the assets of the business or the stock and the equity?
I am not a CPA and I do not play one on TV. Um, in theory, selling stock is better for the seller, not as good for the buyer. But having said that, almost all sales are asset sales. It just is what it is because, I mean, there's so many reasons, but it also limits the liability of from the buyer's perspective. So I don't know a lot about C corps, and I don't deal with ultra large enterprises, and so I'm sure the rules change when you get to a certain level, but by and large, it's going to be an asset sale.
All right, Mr. CPA. So, what are some of the tax implications of selling your business? How can you make the most or minimize them?
I don't play a doctor, lawyer, or CPA on TV, Kelly. But if I did, I would certainly choose a handsome actor to play me. Um, I'm thinking about Clooney. What do you think, George Clooney?
Sure, that would be good.
Right. So when I talk to my friends and clients that sell, they say you're going to pay a lot of taxes, a lot more than you want. Get over it. And you should actually feel lucky. Hey, I was able to put off taxes year over year, and now the chickens have come home to roost, and I feel it's my time. Hopefully, that's what happens to you. That you feel good about it. Um, I know that there's going to be a basis on the value of what you're selling, and so you've got to know what that is to know what the capital gains or whatever the added value is that you're going to from a tax perspective. One of my clients just told me that his non-compete was taxed higher than other things, and so the value assigned to the non-compete sort of impacted the taxes he was paying. I found that interesting. And obviously, if you owe a lot of money, that's going to go against how much money you're paying taxes on. So you need a good. Do not skimp on your CPA, nor your doctor, nor your lawyer. Do not skimp. If you don't feel a little bit of ouch, or your business consultant, right? If you don't feel some ouch, you've made a deal with the wrong person.
Yeah. All right, so I want to switch gears just a little bit here. Tommy Stewart at Sprinkle Tech at Southview, or he's a Sprinkle Tech at Soundview Landscape. Transitioning to a second generation of ownership, any quick tips on what frameworks you have seen to be successful? And let's just go from there and let's talk about some post-sale considerations and really that transition planning overall. If you have any tips for that, Jeffrey.
So first, there's specific to family. I've got a lot of experience there. I've got the bruises, I've got the scars, I've got the intellect. I've earned my MBA in that specific niche. So there's 5 guidelines that I would really, really implore you to follow on family succession. And it's a lot more complicated than I'm going to give you, but these 5 guidelines. Your son or daughter or cousins or grandkids should first get a real job, even for a few years, before they come work for you. Most people don't do that, right, Kelly?
I didn't do that. I worked at like Best Buy and like retail jobs, but no, I worked for the family business for the majority of my life.
If you're really planning for long-term success, they'll work for 2 to 3, maybe 5 even, but at least 2 to 3 years under a real boss and learn how to be a real employee. That's number 1. Number 2, they should work in different parts of your business as an intern, not just in the one area, but make sure they move around. Number 3, they should work bottom up. Don't just ploop, put them in a key position. Don't do that. Let them work up. Let your employees see that. Number 4, you've got to give them their own area that they can own independent of some other family area. Like if you had 3 kids, they'd each be in their own areas. There should not be overlap at all if you can make that happen.
So like a profit center?
Well, if they can have their own P&L responsibility, that's ideal. So if it could be 3 profit centers, that's ideal. And And then if there's multiple family members, you should hold a recurring family meeting with spouses and even kids, but certainly spouses in that meeting a couple times a year to make sure there's an outlet that you can use for the pressure that builds up inside family dynamics of the different families that are working in this business. So those are my 5 guidelines.
Yeah. And the pressure does build up, as
Yeah.
we know.
Yeah. And so you're asking about any post-sale considerations.
Yeah.
You've got to realize that they're going to change the business. You're not going to like it.
Mm-hmm.
Okay? Get over it. They may want you on board, but even if they do, they're going to learn quickly, no, we don't want them on board as long as we thought we did. And so I would just plan to be connected to help get the employees settled, the clients settled, and then that's it. You got to be willing to get out of the way and let the new owner bond with the employees. So the biggest issues, can I just give you a summary?
Please, that'd be great.
What are the 3 biggest issues I think you're going to deal with if you sell? The biggest is that your identity is wrapped into the business, and you need a plan for a new identity. Think of it as the Body Snatchers. Think of it as sci-fi. You're going to have to take your brain and spirit and extract it from your body and go inhabit a new body, a new identity.
These
Seriously.
visuals, Jeffrey.
Hey, Halloween's coming up. Your identity is wrapped in the business. You have to extract it and come up with a new identity. And if you don't, you could go into depression. You could nix the sale in the last minute. You really need to have what I will call an entrance plan after your exit plan. So that's number 1. Number 2, wanting to stay involved, as I just mentioned, it's going to backfire on many levels. It's not going to happen the way you want it to, most likely. So don't plan on it. My brother was involved in selling our family business, and he was involved. And then at some point, they're like, you know what? We don't need you anymore. It just happens. It happens to everybody. So you got to plan on it. And lastly, this earnout that you agreed to may not happen. 50-50 it'll happen. So if you're not comfortable, you have to negotiate against it or think of it as extra money that you may not get. So I think those are the 3 big summaries.
Yeah, I think we hit on all 3 of those, and I'd love to see that come out in a summary too, because I think that's pretty important. I love how you said the entrance plan after your exit plan. Is that something that you work with your clients on if they decide to, utilize you for your advising?
Yeah. We have one client, a woman, just sold, and she's like, I really need you guys. I need you to help me with this. So it's not common, but we have such a strong connection, me and Mitch and her, that we've helped. When we coach the whole person always. To be a successful entrepreneur, you got to be a successful whole person. In term, the business is there to meet your personal goals, and your personal life impacts the business. And so in her case, we haven't decided yet what that will look like, but we're going to help her.
Cool. Well, I know we're reaching time here. Is there any final notes that you have, or can I tell people about the financial masterclass? I think that'd be a great tool for anybody who's listening in on this live stream today.
Well, we'll have to come back and do another live stream on retiring in place specifically.
Yeah.
Because we only partially touched on that. And so, please tell them about the financial masterclass.
Okay. So it's the 5th annual financial masterclass coming up. It's in January. A great way for you guys to master your financials, a 2-day virtual class. Jeffrey, you obviously know more about it than I do, but I know we share a lot of mutual clients, and they all go to it and they rave about it. They have to submit homework in advance, and Jeffrey and his team put together all sorts of information and data, more than you can get in anywhere else in the industry. I think it's a huge benefit, especially if you're on this live stream, you're obviously thinking about selling or retiring in place or transitioning, and knowing your numbers is a great place to start there.
Yeah. People get benchmarks. We bring on a economist to talk about what to expect in the coming year. I have a client coming on who's been part of 10 transactions, and he's going to talk about what you can do to build the value of your business and what you might be inadvertently doing that's backfiring. Sean Baxter is going to come and talk about the big opportunities he sees for your companies in 2025. We're negotiating with a CFO who may come on and talk about how he creates accountability within his company, which will be good for the controllers and CFOs that listen in. Mitch Katz, of course, will be taking us through all the data and the trends that he sees in the data and teaching everyone how to use the benchmarks in the data.
Cool. Well, Jeffrey, I thank you for your time. Thank you, everyone who joined in with us today. We're going to put this together in a podcast as well as a YouTube video. So if you missed it or you missed the beginning, you can check it out later. Talk to you guys soon.
Thank you.
Bye.